So what are the things that we have covered yesterday? We have covered, we were basically making a chapter wise structure into the amendments for our September exam. So we have done the initial chapters. We have done chapters like supply, wherein we have learned negative list, the two additional paras that we have. We also went and then learned our understanding on chart chapter. We have learned the reverse chart changes that we had, some omissions on that. We have clarified what is local authority. We went on to discuss place of supply. We discussed how the structure of place of supply is going to be impacted because of amendments. Now we are at exemption chapter. Very similar to what I have done. I'm also going to give you a little more understanding on how exemption is going to be impacted by statutory update, as well as the changes that is there in your book, but made applicable only from 1st November. So we'll take the one from the books first. That's my first thought process I'm going to take. So we have done this much. Now we will be moving to, in our part 2 session, we are moving into exemption. So this would be amendment number 5. First thing that we need to understand is introduction of section 11 capital A. There's an additional section now they have introduced called 11 capital A. What is this 11 capital A talks about? So I've charted it out here for you. It's a very simple, straightforward provision. We can learn it. This would be there in your ICA material as like the end of chapter and additional information. You might find it from the book, right? Yeah, so Roshan is back, so he's giving out the page number. That's great. Again, for you to see this, you will have to refer ISM page number 5.140. This is what you refer to get your understanding on what is 11 capital A. A very simple provision. It's empowering section. It's giving power to the government. What powers is it giving? You might find this word general practice repeated in multiple cases when it comes to your 11 capital A. I'll tell you what exactly this particular provision is talking about. Then you will easily be able to comprehend the whole point. The understanding is very simple, straightforward. It's saying that government can exempt GST which are not paid or short paid. What is the structure? Not paid or short paid. Why did someone not pay GST and short pay GST is the next question. They're saying that you can exempt the GST that is short paid or not paid. Why would someone not pay or short pay and the government is coming and saying that don't pay anymore? The reason is general practice. Let's assume that in an industry where they are making watches, I'm giving an example as I'm just finding the product that I found on the table. So suppose there's an industry in which they are manufacturing watches, which are smart watches, right? The problem with smart watches is that sometimes smart watches could be considered as watches, can also be considered as mobile devices, right? It does a lot of activity. Suppose, these are just for example purpose I'm saying, suppose this product called watches, people did not pay taxes because this was exempted, or people thought the product that they have, which are smart watches, are exempted and thereby they did not pay any taxes. But later government clarified that watches which are having the functionality of a screen and then do a lot of functions would be categorized as electronic devices or mobile devices. What happens now? Those people who did not pay taxes, did not collect taxes for a very, very long time, all these people would end up paying taxes now. It will become huge hardship for them, right? They did not pay taxes. Why? Because it was a general practice to treat this particular item as an exempt item. That is the primary reason why they didn't pay taxes. Now later government came up with clarification and said it is taxable. Now what happens to the old taxes that they did not pay? Now the government says that the parliament told the government, if you want, okay, if the reason is general practice that people did not pay taxes or paid low, short paid taxes, what's the meaning? Maybe some product has a lower rate. Watches suppose was taxed at 5%, wherein the smartphones are taxed at, or smartwatches are taxed at 18%. People categorize smartwatches as 5% and then paid only 5% to the government and only collected 5% from the customer. Later what happened? They clarified this should be 18% item, and what about the balance 13%? Or a 12% item they were just paying 5%, or an 18% item they were just paying 12%. All the short amount, government would ideally send them a notice asking them to pay for the earlier transaction also. Now because this causes a lot of hardship, now the government has a power to give exemption if the reason for not paying or short paying taxes was general practice. This is what is section 11A. It's just empowering section. Government can come up with exemption on this. Now there's an interesting note that we make here. What about somebody who was too careful and they paid these taxes? Will they get refund? No such refund is available. So if you have not paid, then you can actually get exemption. If you have paid, gone. That's how they are saying. And they're saying anyway you collected from your customer, no? Then why should I give you some kind of a refund? Okay, so that's a thought process. Is this clear to all of you? 11 capital A, is that clear? Okay. Let us move to the exemption as per statutory update. So the first exemption that we have is just changing the wordings that we have. So I don't think even this should be treated as an amendment. So there was already an exemption that was available for your last examination, that is May 2025 examination onwards, wherein they said now all the ancillary activities of electricity are also going to be exempted. When I say ancillary activity, the main activities are already exempted. Say generation of electricity is considered as supply of goods. It is an exempt goods, there is no GST. Similarly, transmission or distribution of electricity is considered as supply of service and there is no GST on that. Now the next question would be, what about peripheral activities or ancillary activities like shifting the meter or installing this particular meter or meter rent? Would that also be considered to be a supply? They said no, these are incidental ancillary, so I'm going to add an additional exemption to that. So what was given exemption? Supply of service by way of providing meter equipments on rent, testing of meters, transformers, capacitors, releasing electricity connections, shifting of the meters, service lines, issuing duplicate bills which are incidental or ancillary to the supply of transmission, and distribution was the word. They have now rationalized and said the word correctly should be transmission or distribution of electricity provided by electricity transmission or distribution utilities to their customer. So I'm not writing this point in here because I don't think this would look like an amendment either. This was not a case that used to be tested earlier, but considering that we have added an additional person here, and I expect that they might test this up. So I'm going to create a chart out of this after we read this. Now they have added an additional exemption for training partner. Training partner is a term that is being used for NSDC courses. Let me read the entire exemption so you understand this better. Any services provided by, who is providing the service? NSDC, National Skill Development Corporation, which is set up by Government of India, or NCVET, National Council for Vocational Education and Training. Both of these entities work towards skilling India, creates a lot of courses which can be pursued after your graduation to get some job oriented skills for you. An awarding body recognized by your NCVT, that's also another set of people that is working towards it, an awarding body. Then there is an assessing agency recognized by NCVT, a training body accredited with an awarding body. These many people are already exempted. Now they said even a training partner approved by NSDC, their services would be exempted provided they are providing in relation to national skill development programs or any other scheme implemented by NSDC, if they are giving NSDC programs, vocational skill development courses under NSCMR scheme, National Skill Certification and Monetary Reward Scheme, or any National Skill Qualification Framework, NSQF, very popular framework for creating courses. So, if this course comes under NSQF framework, aligned qualification or skill in respect of which NCVT has approved qualification package. If you complete this NSQF framework, you could actually get an some kind of a diploma out of the NCVT. If that kind of a course, if you are providing, 3 people services are going to be exempted. Whatever money collected by NSDC, your NCVT, awarding body, assessment agency, training body and training partner, now they have added additional, right? Okay, now let's try to understand. Let me create a simple chart for you to understand and then remember this. I would call this as 6th point. Exemption modified. Let me call this as exemption modified. Whose services are now exemption modified? Services by 2 segment of skill bodies. One is National Skill Development Corporation, NSDC, or National Council for Vocational Education and Training, NCVT, which provides diploma courses or vocational courses. Bachelor of Vocation is a course that they provide. NCVT works with training partners. Their service is also exempted. NCVT works with awarding, the term that they use is awarding bodies and assessment agencies. That's the term that they use. Assessment agencies. Now, these awarding bodies can have training bodies. All of their services would be exempted provided these are 4 courses recognized. What are the courses which are recognized? 3 of them. In relation to NSDC program and any other skill scheme implemented by NSDC. For NSDC program or your vocational skill development courses under National Skill Certification and Monetary Reward Scheme, or any courses under NSQF. So, this is for courses recognized, which are 3 of them. What are the 3 courses which are recognized mentioned here? One is NSDC programs. I'll explain with examples. These were not something that we would discuss a lot in classes. If there was no amendment, we would have just said about these bodies and then missed it out. Now they have added training partners. They could ask a question on this. For courses which are NSDC programs, schemes by, what is the second party? National Skill Certification and Monetary Reward Schemes. National Skill Certification not schemes, so let's call this as courses. Then the last one would be National Skill, NSQF, National Skill Qualification Framework. That's what I'm writing. Okay, let me give you a broader understanding to all of them. Let's try to get an understanding. See, I'll give you a few courses so easily understand. Say a lot of accounting courses are there in the market, because they believe that even after we graduate and all that, we still lack a lot of skills. So government has so many programs to help people to upskill. And one such organization which coordinates all of this is National Skill Development Corporation. Another body which is doing diploma program, which are short term, 1 year programs, etc. for skill development is NCVT, National Council for National Council for Vocational Education and Training. They do a lot of diploma program, B vocational, Bachelor of Vocation programs. These are provided by them. Now let's differentiate the programs. NSDC programs are generally short term, 3 months program on digital marketing, 3 months on AI, things like that. Now how NSDC programs are done? NSDC will be doing the curriculum, and they will give a license to all of training partners. So if you are a training partner approved by NSDC, you can provide all these NSDC programs. If you are providing these programs, the course fee would be exempted, is the understanding. So whatever money collected by NSDC would be exempted, whatever money collected by training partners would be exempted for courses recognized by NSDC. Okay, only those programs which are coming under this. Now you want to do another route. Say you wanted to provide a diploma program. Who would provide diploma program? Colleges could provide, universities could provide, vocational bachelors they can provide. Now all these programs that you structure in university level, which are diploma programs, which are vocational bachelors, this needs to be approved by NCVT. And who will be considered to be the awarding body? Say for example, Amrita University, Sharda University wanted to provide a BVoc program. Now Sharda University would be considered to be what? Awarding bodies. Now under Sharda University, any colleges could be providing this program. All those colleges would be considered to be training bodies. Are you guys understanding? So NCVT is the one which is giving approval to awarding bodies to provide a new course. The curriculum should be approved by NCVT so that there will be a diploma or a degree that is provided. They will be given by awarding bodies, and then there is training bodies, which are colleges. Awarding bodies are universities who are going to give you certificates after you complete this. Then there are assessing agencies which are like computer centers or examination centers who are going to collect money and then allow you to come and then write an examination. So these three people are the ones who function for providing diploma courses with NCVT. So the courses that is done by NCVT would be exempted, is what they are talking about. So whose activities would be exempted? The money collected by the training bodies, the awarding bodies, the assessment agencies for exam, all of them would be exempted provided this program is recognized by one of these courses, NSDC program, or it should be part of a National Skill Certification Monetary Reward Scheme, or it should be accepted under NSQF framework. Is that clear to all of you? Now what is the amendment here? Now earlier the exemption was only for NSDC. Now they have come up and then clarified that the training partners under NSDF also would be, NSDC programs would also be getting exemption on their money collected. If this is clear, can I have a quick yes on the chat box, everyone? So let's look at the next additional amendment that we have in exemption. A new exemption is inserted under serial number 36B. What is this new exemption that has been inserted here? They said services of insurance provided by Motor Vehicle Accident Fund constituted under section 164B of Motor Vehicle Act 1988 against contributions made by insurers out of the premium collected for third party insurance of motor vehicle. You're pretty sure that you would have heard about this particular exemption, that there are certain exemption that is available for certain type of government insurances. Most of the insurances are generally taxable. Okay, there's not generally insurance premiums are taxable. Now we are talking about specific insurance called third party insurance. I'm pretty sure all of you heard of this term called third party insurance. What is it? When you have an accident in the on the roads, this insurance will be given to the third party, like the party on which whom you have caused a loss. That will be the insurance that is called as third party insurance, and it is mandatory as per Motor Vehicle Act that everybody takes something called as third party insurance. If you want to take your car or bike into the road, you're supposed to have third party insurance. Now what do? You normally purchase insurance. Okay, you normally purchase insurance and you will get something called as a third party insurance without any problem, right? Yeah, anybody who is there will give you third party insurance as such. Now the next question is, when there is third party insurance, what is happening on the background? You might be taking something called as a insurance from, you might be taking something called as an insurance from a private insurance company, like it could be HDFC, it could be SBI insurance, or it could be Oriental, New India Insurance, something. All of them would be paying a portion of the premium collected to this particular fund called as Motor Vehicle Accident Fund. This Motor Vehicle Accident Fund is getting contribution from whom? Insurers, insurance company, out of the third party insurance collected for the motor vehicles. This insurance premium would be exempted. Now let's try to write this. Let's try to understand who's paying this to whom. So we would call this as, in exemption chapter, call this as 7th point. One exemption was modified, now we have an exemption inserted. Let's call this as additional exemption inserted. A new exemption, right? So who's the supplier here? Who's the supplier? Supplier would be this Motor Vehicle Accident Fund. Motor Vehicle Accident Fund. They are providing what? Insurance services like reinsurance. Why? These are provided to insurers, and insurers are giving what? They are paying premium from third party insurance premium collected. From customer. And this would be exempt. Let's try to understand with some numbers. Say I am taking a car insurance. I paid 5,000 rupees as a third party insurance. to Oriental Insurance. Oriental Insurance is paying to this motor vehicle accident fund 2,500 rupees. Whatever I pay to the Oriental Insurance, I am paying anyway GST. But whatever Oriental Insurance is paying to motor vehicle accident fund out of the third party insurance premium collected would be exempt from GST. So whatever this Oriental Insurance is paying to motor vehicle accident fund, there is no GST applicable on that. Is that clear, all of you? It's a very simple point to remember. This is the definition of insurer, not very relevant for us, so we will move to the next clarification. Let's try to understand this clarification. It might be tested because services provided to local authority is a very common, services provided to a local authority is a very common, or government or local authority is a very common question that multiple examination has tested. So this could also be an testing point that they can create. Even in the compulsory question, they can give you something like this. Very easy to put it in an exam question in my head. Let's try to understand. It's very logical also to not give exemption to this entry. If you read, you will understand. Then we'll make a note. This is the entry that we have to first understand. To understand this clarification, you should know what is exempted. We are talking about serial number 3A of notification 12/2017, which is the exemption notification. It's saying that there is exemption to composite supply of goods and services in which value of supply of goods constitute not more than 25% of value of the said composite supply provided to government or local authority by way of any activity in relation to any function entrusted to Panchayat or municipality under 243G, 243W. So they said Panchayat under 243G of Constitution or in relation to any function entrusted to municipality under 243W. There is an exemption like this, which is any third party providing services or goods plus services to government or local authority would be exempted, provided if it is goods plus service, the goods has to be less than 25%, and this activity should have been taken for the purpose of Article 243G, 243W functions, which include urban planning, waste management, sanitation conservancy, public health. A list of services are there. There is no need to by heart these service lines. Now let's look at what is this clarification. It makes total sense. Clarification in sense in respect to applicability of GST on facility management services provided to Municipal Corporation of Delhi headquarters, your MCD headquarters. Municipality of Delhi is getting services. What services? Facility management services. MCD is receiving services such as housekeeping, civil maintenance, furniture maintenance, horticulture, which means lawn maintenance, your outside plants, etc. horticulture, from facility management agency for upkeep of their office. This is the major point. Question is that if I am getting some services to maintain my office space, can I call this activity to be in relation to my function under 243G, 243W? The issue which arose consideration was whether such activity received by them are exempt under this exemption notification. Clarification says service of facility management such as housekeeping, civil maintenance, furniture maintenance, horticulture agency for upkeep of office of MCD are not supplied in relation to performing any functions entrusted to municipality under Article 243W of Constitution of India. Municipalities' functions are in Article 243W. They are saying that this is not an 243W activity. Therefore, thus it has been clarified that GST applicable on the service provided by facility management agencies to MCD for upkeep of their headquarters buildings at applicable rate, as these services are not covered under the scope. Okay, how do you make notes on this? I will connect this to the exemption that you have. I would call this as clarification number or amendment number 8. I would call this as clarification on exemption for pure service to government or local authority. Okay, now let's first look at the exemption. What was the exemption that was available? The exemption was written like this, very simple, straightforward writing. It was written like this. I would call this as existing exemption. There's two activities. One is pure service. Let's call this as only labor. Right? Second, composite supply of goods and service, where value of goods, this is tested multiple times, value of goods is less than or equal to 25%. These are the two services which are exempted. These two services provided by any third party. They had not defined who should be the supplier. Any third party can provide. Okay, any third party to government or local authority. This was getting an exemption. Is exempt, no GST. But there is a condition. Provided the said activity is in relation to, this is for what reason? In relation to functions of panchayat or municipality under Article 243G or 243W. This was a condition that they have put. Okay. So, the said activities in relation to functions of panchayat or municipality under Article 243G, 243W, then this activity would be exempted. Now, the clarification is on this part. What are the functions in relation to panchayat and municipality which are mentioned in 243GW? Example could be urban planning, waste management, public health. All of this can be considered to be in relation to 243G, 243W. Now, qualification is on something very different. What is it? What if panchayat and municipality get some services to maintain their office? Can I say it is part of urban planning, waste management, public health, of the function of panchayat and municipality for people? No. Their office management cannot be treated as a function under 243GW. Constitutional functions are for public welfare, not their office upkeep. So, they said the clarification is on contracts for upkeep of their municipality headquarters, like housekeeping, furniture maintenance, what was the other thing? Furniture maintenance, and they also listed something like horticulture, lawn maintenance are not 243W activities. So, are they taxable if it is provided by a third party to municipality, or they are exempted? Hence, third party providing this to it would be taxable. That's your understanding. Is this clear, all of you? So, you will get exemption if this, first of all, it should be any third party can provide services. The recipient has to be government or local authority, and it has to be 243GW activities. It should be relating to that. So, to get urban planning, to do public health, okay, so a third party is giving ambulance services to government or local authority would be exempt. There has been clarification on that. So, there is some kind of a labor contract that is given, and which are in relation to Panchayat and municipalities 243GW activity would be exempt. All of them would be exempt. But maintaining their headquarters is not 243GW activity. So, if third party is providing that services to local authority, would not be getting exemption, it would be taxable. Is this clear, all of you? Can I have a quick yes on the chat box, please? Perfect. All right, so let's move to the next chapter. So, we are done with exemption chapter as well. So, we'll move to input tax credit chapter. Input tax credit has just one clarification, which is something that I would have already done during my regular lecture, because I elaborately talk on ex work and free on road contracts. So, those students who have got this understanding would understand this without any further explanation. However, since I am doing a session generic, I am going to give you that whole understanding in one shot. So, the next chapter is I would like to call this as amendment number 9. Clarification on ex work contract. So, it is not like I should clarify ex work contract outrightly. First, I should give you understanding about what is ex work contract, right? See, when I am purchasing some product, I could basically, domestically, we generally use two terms, right? These are pricing terms that we have. One, we would call this as ex factory pricing, another is called as free on road pricing. To give you a simple example, I wanted to purchase a product from Chennai. I am located in Kochi, Kerala. I wanted to purchase product from Chennai, and it is steel. I wanted to purchase heavy metal steel from a factory in Chennai. I have found out two factories, and I am saying that both of them I will take quote, and whichever is lower I will purchase from. The first factory said for 1 kilogram of steel they are going to cost me 100 rupees. The second factory said 105 for 1 kilogram of steel. In a normal scenario, I will go to factory number 1 because they are giving the same product for 100 rupees. Factory number 2, it is 5 rupees extra. I would say that no, I don't want to purchase from you. However, in reality, in practice, I cannot compare the pricing just like this. How do I compare the pricing? I should compare the pricing asking them what kind of delivery contract are they suggesting. First factory said my delivery is at my factory gate, which means what? If I want the steel in my factory in Kochi, I myself will have to arrange for transportation, pick up the product from the supplier's location. However, the second factory has said my pricing of 105 rupees per kg of steel is not for delivery in my location, I would get it delivered to your location. So, the first contract is called ex-factory contract or ex-work contract, wherein the delivery is promised by the supplier at his factory gate only, and the transportation from the factory gate to the location of buyer is arranged by the buyer itself. In a free on-road contract, the buyer is forgetting about the transportation because the transportation is the promise of the supplier. So, the price that is quoted by the supplier is inclusive of transportation. So, this is a very two popular contract. So, to compare the pricing, you should always compare ex-factory price of one product into ex-factory price of another seller. So, this ex-factory price of one product from one seller, I can only compare it with ex-factory price because transportation would make huge difference in terms of the pricing. I hope you are understanding what is this two contracts are. Now, let us read about these contracts, whatever I have summarized onto the screen. Ex-factory or ex-work contract is a contract where price of the goods by supplier does not include transportation to the buyer's premise. The contract price is for delivery at factory gate of the supplier. Now, the recipient of goods is arranging for transportation here. Instead, in an FOR contract or free on-road contract, contract price is for delivery at the location of the buyer. The price includes transportation charges, and the price and the transportation charges of price of the goods and the transportation charges will be considered to be a composite supply. For valuation chapter, we used to consider this as just one supply. So, give you an example, an AC, air conditioner, I bought an AC for 30,000 and there is 2,000 delivery charges. The seller has said 32,000 for the AC. Now, would I have two separate bill, 30,000 for AC and 2,000 for delivery? No. This 32,000 would be considered to be a composite supply, wherein my contract itself is an FOR contract. Whatever amount of transportation charges incurred will be included in the value of goods. This is the structure. Here the supplier is arranging for transportation and recipient will be taking input tax credit when the goods are received by them, which I will come back to. So, first answer my question on the chat box. Did you understand the difference between an ex-factory contract and a free on-road contract? Did you understand this? Okay. Now, if you understood this, answer my question. I am going to put that question on as a poll here. Let me see if I can do a poll in the chat box. Okay, so what is the, I'm asking you a question, what is the price or value of supply in ex-factory contract for supplier? What is the price or value of supply in an ex-factory contract for supplier under GST? I am putting option 1, only value of the product. Option 2, value plus transportation. Whose end I am asking? I am asking from the end of the supplier. In an ex-factory contract, what will be the value of supply? The correct answer is only value of the product, only value of the product. Why? Because here the transportation is arranged by the recipient. So why should it be included in the value of the supplier? Supplier, I'm only paying for the X factory. You tell me the same answer for free on road contract. What will be the value of supply for the supplier in a free on contract? Is it 1, that is only value of the product, or 2, value plus transportation? It is value plus transportation. This is a discussion that we generally have in terms of X factory and free on road with respect to value of supply chapter. Now I am going to explain you the same understanding with respect to input tax credit. If you remember, input tax credit in section 16, it states what are the conditions to be satisfied by a registered recipient for them to take input tax credit. 16 subsection 2 is what is listing what are the conditions to be satisfied. Now we have 6 conditions, 4 main, 2 additional. So in this 6th condition, first condition says that you should be having invoice with you. Right? First condition is that you should be in possession of an invoice. 16 subsection 2 clause A. For you to take ITC, you should be in possession of an invoice. What is condition number 2? You should have clause B. What is clause B? 16 subsection 2 clause B says, when can you take input tax credit? Can I take the ITC in the month in which I got the bill? No. I should have received goods or services for me to take input tax credit. Right? Receipt of goods or service. Perfect. So my question further to all of you would be, what is the meaning of receipt of goods or service? In both of this contract, let's try to analyze when can I take input tax credit, when would I be considered to have received goods or service. My first question, in an X factory contract, as a recipient, I arranged for transportation. My lorry is going to come, my truck is going to come to the factory gate of the supplier, get the product from there and then transport that back to my location, right? When can I take the input tax credit? Can I take the input tax credit when the transporter that I arranged picked up the product from the factory gate of the supplier, or I can take the ITC only when the goods are finally received in my factory? You logically think and then tell me, what is the point of receipt of goods by me? At the factory gate or at the location of recipient? When do I say that I received the product for me to take ITC? Say in January month, my transporter picked it up from the location of the supplier and he transported and then delivered to me in February. When the product is picked up by the transporter, who's the owner of the product at that time? Will the recipient be the owner of the product, or transporter is the owner of the product, or supplier is the owner of the product? Because it is an X factory contract, delivery is finished where? At that factory gate of the supplier. So when can I take the input tax credit? I can take the input tax credit when my transporter is picking up the product from the factory gate. Are you guys understanding? This is what is the primary clarification they are giving under 16(2)(b). Look at clarification here. ITC can be availed in an X work or X factory contract when the goods are received by transporter on behalf of the recipient. Done. You tell me in a free on road contract, when can the recipient take the credit? When will I consider the goods are received? Will I consider the goods are received when the transporter picks it up from the location of the supplier, or when the recipient is actually receiving the product at his location? Who's arranging transportation in a free on road contract or in a FOR contract? It is arranged by, in an FOR contract, the transportation is arranged by the supplier itself or the seller itself. The seller is still the owner of the product until the product are delivered at the recipient's location. So ITC can be only, the recipient can take ITC when it is received at buyer's location, that is recipient's location, is what 16(2)(b) is talking about. Are you guys understanding this? They also further clarified in particular into X work contract was analyzed in particular into a motor vehicle industry. Okay. Now I'll tell you with an example on how it works in a motor vehicle industry. Say very recently we bought a car. So how it worked? We went to the dealers, did test drive of couple of cars. Then we liked the car. We gave an order to this dealer. What the dealer did, dealer went to the website of the manufacturer, manufacturing unit is in Chennai. So they went to the website of the manufacturer, gave an order. Now the manufacturer started assembling all the vehicle items, created the vehicle, fully done. Then they updated to the dealer saying that the vehicle that you made an order is ready, why don't you start making payment? Now the dealer made payment. After the dealer made payment, the factory said, okay, now you're ready to get the vehicle picked up. Now, who's arranging for transportation here? The dealer is arranging for the transportation, and the manufacturer is giving the product or the car or only at the factory gate. So, the next question would be, when can the dealer take the input tax credit? The dealer can take the input tax credit when their transporter picks up the product from the factory gate of the original manufacturer. Now, original manufacturer has a fancy term in industry. We call them as OEM. What is the term? OEM, original equipment manufacturer, right? So, OEM is the original supplier, that is the manufacturer, when they give the bill to the dealer. First condition should also be satisfied. So, they give the bill to the dealer, and the dealer's transporter picks it up from the location of the OEM supplier. That is the point when they can take the input tax credit. So, you can read it from here. Look at it on the screen. In an ex-work contract for motor vehicle, dealer can avail ITC when OEM supplier bills the same and hand over the vehicle to the transporter at his factory gate. Right? So, that's the point when they can take the input tax credit. Then there is one slight risk that you have. What is the risk? What if the product never reaches? What if the product never reaches? What if the product never reaches the location of the recipient, the dealer? After taking the product, what if the dealer sends it for some personal purpose? Or what if the dealer takes the product and then and in between it was lost, or they write it off, they give it as a gift? Now, what is this ITC that they have already availed? When did they avail the ITC? When it was picked up by the transporter. Can they still be eligible for the ITC if they are not using it in the business? These are two things that they have clarified. The answer is absolutely no. So, all other conditions will still remain applicable here. Now, look at the point number 1. What if such goods are diverted for non-business purpose before receiving at recipient's location, or subsequently? Either it has reached, then they diverted for non-business purpose, or even before reaching you have diverted for non-business purpose. 16 subsection 1 can be invoked, and it says what? The goods or services that you are receiving should be used or intended to be used in the course of furtherance of business for you to take ITC. If it is not, you cannot take ITC. So, ITC is not available if it is diverted for non-business purpose. The second question, what if it is lost, stolen, destroyed or written off or disposed of by way of gift or free sample? They are saying that if the goods are lost, stolen, destroyed, written off or disposed of by way of gift or free sample, there also the structure comes the same. ITC is not available under 17(5)(h). Blocked credit says that if the goods that you have taken ITC is lost, stolen, destroyed, written off or given as gift or free sample, reverse the ITC. That will be still applicable. Is this clarification clear to all of you? Everyone? Okay, perfect. Now, there is one additional amendment that we have in another chapter, which is not there in your statutory update, which would be chapter time of supply. And I am going to club it with invoice chapter also, because both of these amendments are on the same points. Okay, so this amendment, first one is on time of supply provision. So, I would call this as amendment number 10. I would call this as amendment in section 13, subsection 3. What is 13 subsection 3? RCM on, time of supply for service under RCM. The existing provision has been slightly modified. This is okay. So, Version is back, so I would just put the ISM page number also for you. It's 6.56 if you want to look at the ISM. This is a Finance Act change again, not a statutory update change like that we have looked at 11 capital A. This is here also is a Finance Act 2024 change. The effective date happened to be 1st of November. That's why it was applicable for September exam onwards. Right? Okay. Let me take you through the portion. It's a very simple amendment to look at. I think if you've attended my classes, I would have already discussed this, but just for the sake of, this is a very high chance that this can be tested. That's why I'm particular that I discuss this in detail. I'm also going to give you a example question as well, so that you will be able to write the answer if something comes on the exam. All right, so let's look at this understanding. So to get your understanding correct here, I wanted to discuss a bit about invoice as well. I'm going to put a reference provision. Reference provision is 31(3)(f). This is nothing but invoice under RCM. What is invoice under RCM? Say this is a recipient and he has a GST number, which means he is a registered person. He is receiving either goods or he is receiving service, right? He is receiving goods or service and it's taxable under RCM. However, the supplier guy is unregistered. He's an unregistered person. So the problem here is that this supplier is not going to issue invoice under GST. Why? The supplier is not registered, so they can't issue invoice. Now the next question is, if the recipient is liable to pay taxes, under RCM. So the next question would be, who would give you the invoice here? Because the supplier is unregistered. Normally, even if it's under RCM, the supplier will give the bill and the recipient pays taxes, but supplier is not even having registration. How can I ask him to issue tax invoices? In this case, 31(3)(f) says the recipient needs to issue invoice. This invoice is called as self-invoicing at times because the recipient itself is preparing invoice for them. So this is called tax invoice under 31(3)(f). Now they put a time limit for this. This is called self-invoicing or invoice under 31(3)(f). So if you know this particular provision, it will become a little more easy to understand the context. Now they have said in the provision earlier in 31(3)(f), and then if you go and then refer the corresponding rules you would understand that, okay, 47A, if you analyze, it was earlier said that it should be issued within a prescribed time. Now they have prescribed the time for your examination. They said after receiving the services, if the invoice is an invoice under RCM, recipient who is getting goods or services from unregistered person should issue this invoice under RCM within 30 days of receiving the supply. Understanding? So the recipient has been given a time limit to issue invoice within 30 days from the supply after receiving it. What invoice? 31(3)(f) invoices. It's a very similar provision that we have after providing the supply. If it is under FCM also, in services within how many days they are supposed to issue invoices? 30 days only. So now even if the recipient is issuing invoices, they will also issue invoice within 30 days. That's the basic understanding. Okay, after completing services, similar that they said that this invoice needs to be issued within 30 days, right? Now look at the structure of the provision. Now how do I determine time of supply? They said time of supply earlier was determined for services comparing two things. What are the things that they compare? Section 13 subsection 3, if you analyze, the time of supply for recipient of services under RCM was very simple provision. It's saying it is earlier of date of payment or 61st day from date of invoice. When they earlier mentioned 61st day from date of invoice, the thought process was whose invoice here? Supplier's invoice, which means the supplier is registered and it is under RCM. So supplier's invoice is what they were talking about. However, what if the supplier is not registered? Then I need to compare it with some dates. So they said, don't worry, if the supplier is not registered, you can compare it with the date of invoice issued by recipient under 31(3)(f). So what they have done, they added an additional item and said the date of invoice issued by recipient should be also considered while determining time of supply for recipient under RCM for services. Why not for goods? For goods we already had. First of all, RCM for goods are not part of your intermediate syllabus. But if you analyze it, you would understand that they already had three things to compare in terms of time of supply for RCM for goods, which was date of payment, 31st day from date of invoice, and date of receipt of goods. There was no such provision in services. That's why they've added date of invoice issued by recipient, which is like within 30 days, should also be compared for determining time of supply. So how do you analyze this? If you want to analyze this, you should analyze it based on whether the supplier is registered or unregistered. Now I have analyzed this into an additional provision for you. If you want to understand this, I have put it into a chart for your easy understanding. In your chart book, if you have the latest version, or if you might have this chart with you, that's where I have consolidated the entire point. They said your time of supply under RCM can be based on your supplier is registered or unregistered. They're saying that if your supplier is unregistered, in services, what is that you will compare for time of supply? Date of payment with the date of issue of invoice. Which invoice am I talking about? Recipient's invoice under 31(3)(f). If the supplier is registered, for services you compare what and what? Date of payment or 61st day from the date of invoice. So it is not like you compare both, you will compare only one of them. Why? If your supplier is registered, then you will compare 1 and 2 in here. If supplier is unregistered, you only give the bill, so you will only have 1 and 3 to compare, right? Now what is this additional changes that you have? They said additional rule that is saying 47A is inserted and said the due date. What is the due date before which they had given prescribed time earlier? Now they said the invoice needs to be issued within 30 days from the receipt of supply. Very simple provision, like FCM only. Within 30 days of the supply, you issue the invoice. Even as a recipient, as a supplier, same. Now how do you check this in an examination question? You will have to look at, if the question is talking about invoice date, then we will assume this invoice date is supplier's invoice date. If they have said that the supplier is not registered and not issuing invoices, then we will have to look at the invoices for the recipient. Now look at the example question that I have given. It's very important from an examination perspective. Mr. A.R. Rahman received 1 crore as royalty from T series for a music composition on 10th June 2025. Case number 1, compute person liable to pay GST on royalty. We know that if there is a music composer providing services to a music producer company, it will be the producer company who pays tax under reverse charge. So it's T series who will pay tax under RCM. Assuming ARR is registered, so ARR1 has a GST number, then and issued invoice on 10th April, what is the time of supply for T series? So here the supplier is registered, so I will compare 1 and 2, which is date of payment, that is 10th June 2025, and 61st day from date of invoice, that is 10th April is the date of invoice by ARR1 plus 61 days. In April 20 days, May 31 days, and if you add 10 more days in June, you will make it 61 days. 10th June with 10th June, it's again the time of supply would become 10th June itself. As simple as that. Otherwise, you compare whichever is earlier. What if case number 2 comes in? What is case number 2? Assuming AR Rahman is unregistered, who should issue the invoice? If AR Rahman is unregistered, the invoice needs to be issued by T series, right? Under which section? 31(3)(f). And what is the due date of invoice for T series? That is 30 days from the date of receipt of service. Assuming T series issued invoice by 10th of May 2025, what will be the time of supply? They are saying that date of payment is 10th June, date of invoice under 31(3)(f) is 10th May. 10th May would become the time of supply for T series to pay taxes. Earlier it was 10th June. So this is how the comparison could be for this particular case. Is this clear, all of you? Can I have a quick yes from everyone, please? Alright, so let's move to the next chapter. So invoice also I would consider it to be done because I have finished that together with it. Next is e-way bill. It's a very small amendment. Let's look at what is that e-way bill talks about. They're talking about something called as unique enrollment number. Let me go through the provision and then give you a small note to understand this. It's just a one-liner understanding. Fourth proviso is inserted. Fourth proviso means there are already 3 provisos where they have listed other parties to do enrollment number, but they are now saying that by notification effective from 11th of February 2025, newly inserted fourth proviso says following persons are required to generate e-way bill but will submit the details electronically on the common portal in prescribed form. Upon validation of the details so furnished, a unique enrollment number will be generated and communicated to the said person. Who are these people? An unregistered person making interstate transport of handicraft goods which are exempted from obtaining compulsory registration and required to generate e-way bill irrespective of the value of consignment. Second one, an unregistered person opting to generate e-way bill. Very simple thought. I will put these 2 persons first. I would call this as amendment number what? 11. Unique enrollment number. First, let's look at person who's making interstate supply of handicraft goods. This is the first category person. What is special about this fellows who are doing interstate supply of handicraft goods? First, no need of Normally, if you are making interstate supply of goods, you need to take compulsory registration. For this fellow, need not take, no need of compulsory registration. So, there is no need. They can wait for their threshold limit. So, what happens? Government wants to track them. What is that the provision that they have given? They said, however, they need to generate e-way bill for all supply, irrespective of consignment value. What is the meaning? Normally, what is the consignment value? Normally, e-way bill is required only if, what is the consignment value limit for e-way bill requirement? Exceeds what? 50,000. Perfect, guys. Normally, there is a limit. Only if the consignment value exceeds 50,000 is required. But this limit is not applicable for whom? The interstate supply of handicraft goods and somebody who is a job worker making interstate supply. These people need not look at this 50,000. They will always need to do what? An e-way bill. The next question is that to do e-way bill, they require what? They require a GST number. But if they take GST number, they will become registered, no? So, they are now doing, they are getting the benefit of, they are saying there is no need of compulsory registration. But to do e-way bill, they need to take registration, which is like contradicting provisions, right? So, instead of obtaining GST number, GSTIN, they can obtain unique enrollment number from portal to generate what? E-way bill. Understanding? Don't take GST number, take unique enrollment number. Then you can generate your e-way bill. That's enough. Is it clear? One more fellow. Who needs to do that? An unregistered person wanting to, he need not generally do, but an unregistered person wanting to generate e-way bill voluntarily can also do the same by generating unique enrollment number. Instead of what? Instead of GSTIN. Is it clear? Is it clear, all of you? Can I have a quick yes? It's a very simple provision, no? Logical. Okay. Don't take GST number because they are unregistered. Just take an enrollment number. That's all they're saying in this particular area. right? So that chapter is over. All right, so payment of taxes, this is not a new provision, but I would like to take a moment and then explain you this whole interest computation if you guys want, because it's a easy discussion for me to have. Okay, shall we do that? Okay. Let me explain you this very simple thing. I'm going to call it as chapter payment. This is 11, 12, I'll call it. So they have inserted a penal provision from financial year 24-25 onwards. There's a new penal provision called 74A. Demand, I would call this as amendment 12. Demand under GST. This is, in details of this you will learn at CA final level. Demand under GST can be done over section 73, 74. Okay, there were two sections. This is going to be used till 2023-24. From 24-25 onwards, any demand notice will be generated under 74A. What is this demand? Maybe there is some, why would they do the demand? There is some tax not paid. Why there is demand? Why would the government demand them to pay GST? Because there is some tax not paid, short paid, ITC wrongly availed, and erroneous refund. Refund is taken by mistake. So this government wants to demand it back. So they use these two sections. They would ask in this notice, and they will raise a says shockers notice, SCN, asking assessee to pay tax plus interest plus penalty. In that case, interest will be computed on tax paid by debiting electronic cash plus electronic credit ledger. We can call this as gross GST liability. say, I'll give you an example. What is the meaning of this? Say, for example, government identified that I have to pay some taxes. I did not declare the taxes correctly. So they identified that there is a tax payable of 1 lakh. Now I have to pay this 1 lakh, no? What I did, I looked at my electronic credit ledger, there was 50,000 rupees there. So I paid by 50,000 by electronic credit ledger, balance 50,000 I paid by cash. Right? My question is that when they generate this particular demand notice, they will also add interest. Will they add interest on the amount payable by cash, or they will add interest on the gross liability itself? Whenever there is a demand raised under 73, 74, now 74A, all these three sections, you will have to pay interest on the entire liability, not on the net GST payable. When will I have net GST payable interest? Only cases where I delay in filing my GSTR 3B. Monthly I have to pay by 20th, no? That I delayed and I paid by 25th. I filed my 3B by 25th. I need to pay only on the net GST payable after reducing anything that is left out in cash and all. Was an amendment earlier. Now they are saying that if anything is payable under section 73, 74, 74A, you will have to pay on the gross GST liability. Say there is 1 lakh rupees, the GST that is missed out to declare, and I got a notice. When I pay this 1 lakh, I will have to pay 1 lakh plus interest on 1 lakh. Not on out of how did you pay this 1 lakh? Did you use some amount in credit ledger? Doesn't matter. On the entire 1 lakh, you will end up paying interest. That's the clarification now you have. This was already there for 73, 74. Now they said 74A also would apply in the same manner. Is that clear to all of you? Okay. Now let's look at the last amendment that we have. In returns chapter, they made a additional clarification on form GSTR 7. Let's try to read this up. It's a very small amendment, not you will understand as we read. So let's see. The due date of filing GSTR 7 specified in Rule 66. So, Rule 66(1) amended now. Erstwhile, Section 39(3) provided that every registered person is required to deduct tax at source under the provision of 51. Right? So, Section 51 talks about TDS. Government, local authority, other notified person, like the 7 of them who would do the TDS. And they will have to do, after doing TDS and depositing this money, they will have to allocate this TDS deposited to the respective suppliers by filing a return called GSTR 7. And the manner electronically I will have to file for the month in which such deduction have been made within 10 days after the end of such month. So they have specifically mentioned that GSTR 7 would be filed only for those months you have deducted taxes. Now they amended that. That's it. 39(3) substituted by Finance Act number 2, 2024. But the effective date is 1st of November 2024, is to mandate the electronic furnishing of return for each month by a registered person required to deduct tax at source, irrespective of whether any deduction has been made in the said month or not. So what is that? They're saying that earlier the wording is that you have to file GSTR 7 only in those months where TDS is deducted. What if in a month there was no TDS deducted? You will have to now still file GSTR 7. What GSTR 7 you will file? Nil GSTR 7. So look at, therefore earlier filing of monthly return in GSTR 7 was linked to calendar month in which tax has been deducted at source by TDS deductor. However, amended section 39(3) mandates furnishing of GSTR 7 for each month by the TDS deductor irrespective of whether any deduction has been made in the month or not. Further, new section provides that the time within which GSTR 7 is to be filed shall also be prescribed by the rule. Consequently, simultaneously with effect from 1st of November, Rule 66(1) has been amended to prescribe the time limit for GSTR 7 can be filed. Now, how the section is now drafted. Every registered person required to deduct tax at source under section 51 shall electronically furnish a return for every calendar month of the deductions made during the month in which such forms and manner within the time as may be prescribed, provided that the said registered person shall furnish a return for every calendar month, whether or not deduction have been made. What is understanding of this? Even if you don't have a deduction, you will file a nil GSTR 7. Now, rule also amended accordingly. Okay, they came up with a clarification on 8th of October and said every registered person required to deduct tax at source under 51 shall furnish GSTR 7 on or before 10th day of the succeeding the calendar month. They have changed the word to calendar month instead of saying that they'll have to do it on the next month after deduction. There's no requirement of you to have a TDS to file this. Very simple and straightforward. There's one more clarification that came in which said that there is no late fee that is available. So I can just put that into one single line and then close it. What is it? Amendment number 13. GSTR 7 to be filed by tax deductors under section 51 needs to be filed even if there is no TDS. Even if there is no TDS, you will still have to do it. So, nil return required. This is the clarification you have. 14 is talking about just a inclusion of your 74A into Rule 88D. What is Rule 88D? Notice for difference. What difference? Say your input tax credit claimed as per GSTR 3B is more than ITC as per GSTR 2B, then you will get a notice under section 80 under rule 88D. You have to reply or pay taxes within 7 days. If not, section 73, 74, now you can get a notice under 74A. They will give you a notice asking you to pay the taxes with penalty. Can be it's a small change, just wherever you have 73, 74, now they are adding 74A. That's it. That's your change that you have in return chapter. Done. Your all amendments are done. So what you do? Ensure that you just go through this the day before the exam or the day of your exam. Just go through this. All the things that I've sorted out here, simple chart based notes, just go through this on the day of your exam or the day before the exam. So that's it. You don't have to worry about any amendments if you have these notes with you, right? So I'm going to put these notes into our Telegram group. So in case anybody has not joined our Telegram group, I can put once again the link into the Telegram group link. I can provide once again. Copied the link and I'm putting it here for anybody who's not joined. You can just go and then do it. Right, so join here. I will just put the link. This video would also be available on YouTube. I hope you would share it to all your friends whom you wanted to see successful in this coming examination. Ensure that you share it with everyone. Okay, so that would be good. Now, how do you prepare? Like from here, just any way that we are connected, we are here. I would just give you a small tips for your exam preparation with respect to your indirect taxes. I'll just show you one screen so that you can understand the approach that you need to take. So you can see something that I've written here. This is the approach in which you should now recap. Do not go from chapter number 1 onwards and then try to finish it off. That's not the method that I want you to do. Ensure that you go from rank A, rank B, rank C. Prepare for the exam. And the exam expect you to start and understand that full net GST questions. So you can even go to ITC chapter, and then if you are taking our question bank, just go to ITC chapter and start solving every question and then go back to each of the chapter. That's a very good method to go and then do. So start with charge chapter. First do all the amendments, AAA category. You've already done that with me. Now you go do charge chapter, value, you can do TCS together with charge, time and input tax credit, exemption. This is the main set. Finish this and then go to place and TDS and registration and supply, and then go to the rank C. In rank C, I have written something in bracket. Those things you will have to be super careful. Ensure that when you're reading those theory areas, you read these things with more focus. See, look at the last area that I've given is introduction. So you need not go through introduction and then spare a lot of time. Understand what is the time available and then do the best out of it. Okay, that's what is required for GST. Always connect one provision with the other one, because it's going to be connected questions that you will have, right? So be active on the group. You can ask any doubts you have and I'm going to answer that there, or one of your friends is going to answer that there. So let's have good discussions there and ensure that we rock this examination. All the very best for all of you, and thank you for your patient listening.